Hello, everyone. Dave and Tom Moore, the Exchange Brothers, and we were out of town for a couple weeks, huh, bro?
Yep. Had a good vacation. Sunny Southern Cal was kind of foggy. So,
A working vacation. So those of you out there that don't know us, we lived together down there in the mid '80s. Tom was going to UC San Diego. I took some classes at UC San Diego, but Tom actually graduated from the school and actually held the all-time scoring record for the water polo team for a number of years until just not that long ago. I'm bragging. He can't brag about himself, but I can brag about him. But it was great to have him down there playing a little bit together, and picked him up from the airport. And immediately we had to go to Alberto's and get some of our Mexican food.
Carne asada and rolled tacos. Yeah.
Had to bring back the good old days. So, but he got to the boat and he said, "What projects do we have?" And I don't want to take advantage of him, but he had some slave labor on the boat during the time we were there. But we were there for what?
We were there for the Emerson conference, and so they are a broker-dealer, deal with all sorts of securities, but this was primarily based around Delaware Statutory Trust properties and some other product that was being pitched by other sponsors at the event. But it was the first time that we had sponsored it, and it was really great to get to know a lot of the Emerson people. They put on a first-class seminar or conference there, I should say. Really good people and a busy 3 days of
Work.
Conference. Yeah, yeah.
Yeah, we had 40 sponsors. So we listened to 40 different companies, and it's really nice for Tom and I because we're not selling this stuff, but we work with it day in, day out. And so we had 40 different sponsors. We had a couple hundred different brokers there. So we met a lot of great people, listened to a lot of those product pitches on a variety of things, like you said, everything from there's several different sponsors talking about houses, taking in houses on these DST. They're not necessarily DST structured things, but similar to that. And then we had some oil and gas pitches also, and then the whole gamut from multifamily mini storage.
Yeah, and pretty much everybody had something that was being pitched that would qualify for 1031. Some of it was not aimed that direction, but most all of the sponsors that were pitching product had a 1031 product that was available, something that would qualify. And yeah, it's great. We always get asked about what qualifies, what's like kind, and the DST field has been growing over time, and it really has grown into something that has got something for everybody. And like you say, whether people are interested in single family houses, or getting into the self-storage, senior housing, all that stuff has been big for a long time, but there really is a lot of product out there and a lot of different housing classifications. So it's really good to see what's out there.
So it's sort of funny because you and I obviously been dealing with this stuff, not the DST product. It came to be around 2000, but dealing with investments and fractional ownership of investments. And, pre that period, it was always Tenancy-in-Common. And you look at the fact that partnership interests don't qualify for 1031 treatment, and you think about, okay, a DST, and well, why does the DST qualify when, I mean, really, there's no reason it should, but I always sort of jokingly say, well, some senator want to do it, but I mean, really, it's a great product. It was created to accommodate people's needs into a fractional ownership, passive investments, and it's a great end game for people because historically, we'd have people start with houses like we did, and they get to bigger properties, and at some point they get tired of doors, and maybe they go into industrial or some other type of triple net type property, which can be very great options. They are a great option, but for the people that just truly want to go check out and go travel, that DST product in today's world is wonderful. And we did have, I think there were a couple pitches with some tick structure too.
Yeah.
And maybe talk briefly the difference between DST and Tenancy-in-Common.
Yeah, well, the tenant-in-common ownership is usually going to you're usually going to have a situation where you've got maybe it's a single property acquisition, and you've got everybody going in on title of the property as tenant-in-common owners. Everybody's got a specific interest in it. The DST is similar as well. You've got a percentage ownership, but a lot of times you've got a whole portfolio of properties that you're going into, and say, for example, you're going into a self-storage DST, you might have, I've seen them anywhere from a single property up to, I think some of the largest we've seen might encompass about 20 different self-storage facilities. And they might be in several different states as well. So it's more like you're buying into, like I said, a portfolio of properties with the DST structuring.
So a couple of weeks ago, we had one of the top people at Emerson in here did a series, and keep an eye on our channel. You're going to see those. If you're on our email list, newsletter list, you're going to see that video before you see this one today. But it was great because Steve was in here talking about the different offerings and what they're doing with it. But so as Tom just said, I mean, a Delaware Statutory Trust institutional TIC is going to be a single asset. Typically, it's a value add play, not always, but usually a quote unquote sponsor is going to tie up an asset, fill the bucket with investors. Then upon sort of that critical mass, they'll buy the property, and typically everyone's qualifying for the loan. All the DST could be a single asset or multiple assets, as you said. So so not only do you have diversification into different offerings, but you can have diversification within the same offering.
Yeah. And those properties, the DST, it's already been purchased. The trust buys it. Financing's in place, and when somebody's buying into it, they're going to be filling slots until until it's fully subscribed. And if I go into a DST that has a 50% leverage component to it, when I buy into it, I'll put my cash down, and then I would I would take on the debt component as well. So you're just assuming a debt component when you're buying into it.
All non-recourse, which is pretty nice.
Yeah.
And I think the other thing that's really interesting about that space is, for people that are, for our clients or investors out there that live off the income off these things, you think about how long when you sell something, if you're going to go out and tie it up, qualify for the loan, get all that stuff done, there's a period of time where you're not making money. And that DST product, I mean, they're able to, if you've got things teed up, we can close the DST purchase within days of the relinquished properties closing, and you can have a check in the mail within a couple weeks even. So it's really, for people that are living off that, it's really attractive, I think, for those people. So it's something to keep in mind, and I think we're sort of in a unique position because we don't sell it. And we don't get paid anything if people buy it. And I think it's been really fun through the years to get to know the sponsors in that space. And just I think the last couple of weeks, it's really been fun for both of us to actually meet a lot of the players that we've been working with and to learn more about those things.
Yeah. And it's not, the DST is not something that's for everybody, of course, but it certainly has a growing market. And I think some of it is due to the fact that, like we experienced down there in San Diego, that there's quite a variety of product that's being put out to market, and it really, there's something for everybody. Whether they want debt or not, you can buy debt-free assets. You can buy leveraged assets. Most of them are somewhere around 50%, or that's what they had been previously anyway. I think when rates went up, there was more of it that was debt-free, but most of it's 50% leveraged, somewhere thereabouts. And then you can get, if you're needing more debt, you can buy into some that are highly leveraged. And again, across all the different platforms, whether it's medical, senior housing, multifamily, there really is, like I say, something for everybody.
So he was talking about LTV, loan to value on that stuff. And one of the big fallacies in the 1031 space is people are always saying you got to replace debt in a transaction. And obviously, that's not true. I mean, if you're working with us, you know that's not true. If you've been watching our channel, you know that's not true. So, as we always say, debt can go away two ways: one by going down in value, the other is by adding cash to a transaction. But if we're looking at these different offerings, as Tom just expressed, there's different loan to values there, and a good broker in that space is going to take a look at our clients' debt requirements, or I just said that it wasn't necessary, but if they don't want to come out of pocket to offset debt, you're thinking about different offerings. There's typically, it's going to be 50%, but there's as much as 80% LTV, and there's zero debt offerings too. So you're just sort of going to take a look at what people are needing, and a good broker is going to match them up with maybe a variety of different offerings, going to get them where they want to go. And I guess the other thing I want to say is 1031 is not all or nothing. So you think about the exchange from the context. Every dollar you spend over your basis represents tax deferred gain. Having tax exposure is one thing, taxes owed is another. So you want to talk to your people. If you have an exchange that you didn't fully meet your value requirements, you might have some boot situation there, some tax exposure. You want to talk to your tax people before April 14th, right? You want to talk to your tax people before year's end. You want to talk to your investment people before year's end. Maybe you can offset some gains with some losses elsewhere, but do that planning piece. But I really think it's interesting when you look at these institutional offerings. They can really, a good broker in that space is going to talk to you. They're going to really, research what your risk tolerance is, and we've got a lot of people. You'd have to agree, I think, that we've got a lot of people that don't have much risk tolerance these days. They're really looking at preservation of capital more than anything else. What good is tax deferral if what you buy goes away? So that reward is always, the higher the risk, the higher the reward. But they're going to sort of stick it in the blender and make it fit.
Yeah, and as you mentioned, there's that debt can go away. We have a lot of people, or it can be a partial 1031 exchange. It's very common. Somebody was asking me the other day about those requirements in going into acquisitions, and do I really have to spend everything? And I said, absolutely not. You can pull money out. You can go down in value. If you go down in value, it's going to result in you either having debt relief because you're not taking on as much debt. Maybe you are spending all your money, or maybe you're going out and you want to take some cash out and go on a vacation or something like that. And absolutely, you can do that. You're just going to pay taxes on that difference. You go down in value, you've either got mortgage boot or cash boot that you get back.
So if somebody wants to pull money out of a transaction, they want to go take that trip, the vacation, and we weren't on vacation the last 2 weeks, we were working, okay? But if they want to take some money out, go take a trip, buy a car, do something else fun, when can they get that money?
Well, there's a couple of times that money can come out. The IRS has the 1031 G6 rules that state specifically, they're not our guidelines, it's the IRS guidelines that state this, but you can either, if somebody knows they want to pull money out, let's say somebody said, I want to take 50 grand out of the deal. If they know that they want to do that at the beginning, then they can take that right at close of escrow, and we'd have a spot on our agreements that say that they're receiving $50,000 in retained taxable proceeds is what we call it. So it'll show up on the settlement statement. 50 grand's going to the client, the exchanger. The balance comes into the exchange account. So they can take it right at close of escrow. It does not come to us. That's key. It goes straight to the client and it's taxed.
So Tom, a few years, I mean, I don't, if it's been 10 years now, I can't remember, but there was some guidance basically that said if you're going to pull it out of close, it had to be excluded via that assignment. I mean, right? Because before, people just sort of pull money out and it wasn't excluded from the exchange. But through the assignment agreement in is it Section 8 on there, I think? Yeah, and you're literally going to write in there the amount you want to walk out of escrow with, and it's excluded from the exchange. So they're not having actual or constructive receipt, or we're not being treated as an agent of theirs and giving it to them after the fact.
Yep. Yeah. It has not come to us. We never were in receipt of it. that was a dollar amount that was going to be excluded from the transaction from the get-go. So it was never to be part of the exchange. That's key. So if the money does come to us, as soon as we're in receipt of it, it's in the exchange account, then we kind of have our hands tied. Now, certainly if the client has an acquisition ready to go, whether it's a new single-family residence they're buying, a DST, a multifamily, whatever they're going into, if they've got that set to go and escrow is closing right away, the money can go out for the acquisitions immediately, whether it's the following day or any point thereafter. But they cannot come to us during the 45-day time period anyway and request that we release funds to them. No funds can be released to the client during the exchange period while they have the ability to still acquire properties. And so really what that means is during the 45 days, no money can go out. If we get to the end of the 45-day time period and they have not identified anything to us, then the exchange is completed. Because they've not identified, we cannot acquire anything for them. The exchange is then wrapped up, and on day 46, those funds can go back out to the client. They have a failed exchange at that point in time. If they have identified properties, then we have to wait until they have acquired all of the properties that they are entitled to acquire through the exchange agreement and the identification form. So let's say somebody identifies 2 different properties on their ID form, and they acquire one of the properties, and there's a little bit of cash left over in the exchange account. If they have not stated, we have a spot on our on the identification form that they can state that they're entitled to acquire no more than blank number of properties. So say they've identified 2 properties and they only intend to acquire one of the properties. They can write on that in the form that they're only entitled to acquire one of those properties that's been identified. If so, after they've closed on the acquisition and after the 45 days has passed, if there's still cash in the account, because they've stated they don't have the right to acquire any others, then any remaining funds can be released to them. However, if they've not stated on there that they have a limited number that they can acquire and they still have other properties identified on the form, then we would have to wait until either those properties have been acquired or the 180 days passes, so the end of the exchange is finished. Then on day 181, we can release funds to them.
So that blank, I think, when we added that number of years ago, I think that was a huge thing for people. I think one other thing that I really think you ought to sort of follow up on is, so if I come to you and say, well, gee, Tom, what do you care? It's just going to be the impact on my exchange, so I don't care if it's failed. It's a failed exchange anyway. Give me my money.
Yeah. So if that were to take place, and we know that we talk about the accommodating accommodator, if that were to take place and we as a firm released funds outside of the G6 regulations like that, because again, these are IRS guidelines and not ours. If that were to take place, then it's the whole practice is faulty, and it's not just that client whose transaction is at risk. Everybody's transaction that we do is at risk because we don't have policies and procedures that will stick with the G6 guidelines. Somebody has it comes down to whether or not somebody has constructive receipt and not necessarily actual receipt. If they've got constructive receipt, then the exchange is not valid.
Big point. All right. So don't just say, well, my accommodator will just give me the money. They're wonderful. I wouldn't use them. I mean, that's and I say that, and Tom and I mean, there have been times in the last 34 years where we've had people upset with us because we wouldn't let money out, but we can't. And like Tom said, it's not our policy. It's federal guidelines that are dictating that. And it's not a question whether you want to take the chance. You say, well, gee, do it. We cannot do it we have to maintain the integrity of our policies and procedures for our clients. One of the other things, when we're talking about ID, I think do not ID something at the 11th hour just in case, because as Tom just said, we can't get the money out. What happens if you decide you don't want it? Now you find what you really want on day 70, and we can't give your money till day 181. That's a real problem. So if you're a broker, really stress to your clients the importance of being either all in or out on day 45. If you've submitted something, rescind it if you're not positive you want it. So we just spent a number of days in that institutional world, fractional ownership of things. You mentioned let's say a DST offering. We talk about a tenancy-in-common offering. It's going to be a single asset. DSTs can be single or they could be multi-asset. So what happens if somebody identifies a multi-asset DST? What is a DST offering with 9 properties in it? Is that 9 properties ID'd, or is that one?
We would certainly consider it to be one asset, one spot on your ID form, so to speak, because you don't have the ability to go out and acquire any of those individually. You've got 9 properties within that DST offering. You can't say, I'm going to buy a number of shares or percentage interest in this property only. And this is really any time that you've got whether it's a DST or you've got a portfolio of a couple of duplexes or triplexes that are sitting in a certain cluster. If you've got one seller, it's one listing. They won't sell them separately. Or if you've got a building and a parking lot that go together side by side, even though they might be different properties, that seller, if it's not, if you don't have the ability to buy them separately, they can be looked at and considered one.
So if it's divisible in any way, then you're talking whatever number it is. But if it's not dividable, so if your purchase sale agreement stating it's all or none, period, you have no ability to break it into pieces, then it would be one. If you got the ability to break it up. So that's a very important point for people. And I would say if you're working with in the DST space, and you got to understand what you're looking at and understand what your accommodator is going to be treating as the ID'd properties, and really understand that before you get yourself in a spot where it's a problem. I guess the best solution for anybody is always to close everything inside the 45 days. That way you don't even have to ID things. So that's always going to be the best way to do it. I would say that's one of the nice things, once again, about that space is that you're not going to have a gap in income if you're really planning ahead, making things happen.
Yeah, pretty common with those types of assets with DSTs that people have identified stuff. They've got brokers that are on the ball ahead of time and that might have the acquisitions all ready and set to go when they close on their sale, so that money is not sitting on the sideline. They get their money right back to work for them. Occasionally they might know of one that's coming out, and it might be a couple of months down the road, and they might wait for that. But usually, when they sell the assets that they want to get into are available, they know there's spots available, and then get right back into them.
So we had a lot of fun down there. We spoke to a whole bunch of different people. Like we said, we felt like we were speed dating through the one day, talking different groups. In general, I mean, everybody was just really open and happy to have us there and asked a lot of great questions. I think there was a comment in one of the sessions. Actually, you probably sat there and laughed because I started going back and forth with the guy a little bit. And finally, it got to the point, it's like, well, you seem to know a lot about this stuff. So what's your point or what's your question? And it got quiet at that point. But at a later point in that conference, there was a person talking about, well, the accommodator would just want them to hold the money, get out of the way. We have had a number of transactions recently where the last session we talked about diving, right? Plan the dive the plan. And if there's a problem, the general rule is stop, because people, if they don't stop, they panic, and that's where you got a problem. I'm going to tell people, and yesterday I was at CCIM, certified commercial investment member. I've been on the board in our local chapter for, I don't know, probably the last 15, 20 years. But one of these days they're going to kick me out, get tired of me. I cause problems in the board meetings. But anyway, I ran the programs for a long time. And we start talking about stuff. And the great thing about our Oregon, Southwest Washington chapters, we've got a marketing session at the beginning of those meetings, a couple hours, and people pitch properties looking for buyers, or they pitch money looking for property, and we sort of talk about how to get deals done. And it sort of comes back down to this comment that I just said about, well, I just want them to hold the money and get out of the way. We talk about the difference between facilitators, intermediaries, accommodators. We talked about that one of the last episodes. And I think we've got a few transactions in the last few weeks that really exhibit this problem. And one that is, I've got transaction right now that a couple of friends that I've known for decades, unfortunately, one of them's got a very, very bad illness. And so we've got a series of properties, a lot of money involved. We've got 3 or 4 different entities, limited liability companies with different memberships. Some of them have kids in them. Some of them are just a couple of the parents and maybe spouses. And really, this is a situation where the one person is just trying to simplify the estate when he passes away so his heirs don't have to deal with this stuff. And unfortunately, there was a situation where some people got involved in the transaction that didn't understand what needed to happen. And so we had a closing happen last week that we didn't get taken care of. It's not that we didn't get taken care of. We were not made aware of it. And one of the parties involved in the transaction had sent it to somebody else that was just being an accommodator. And the problem with that is, it's like, well, yeah, we treat the exchange at the 11th hour. Hey, just tell us who's handling the closing, and we're going to put an exchange agreement together. Well, if you do that and you don't understand the taxpayers' motives, when I was at that CCIM meeting yesterday, people pitch property. The biggest thing I want to know is what's their motive. What are they trying to do? They've got some. We want to know what they have, where they want to be in 2, 5, or 10 years. We want to make sure that we understand the motives to get the deal done, and we're doing it correctly. And this vesting piece is one of the biggest. Time is the biggest issue, but vesting is going to be the second biggest problem always.
Yeah, and it's certainly not uncommon. You just mentioned they've got multiple properties that are being sold at different times under different ownership, and this comes up all the time. And if somebody's just looking for somebody to quote unquote hold the money and do nothing else, then those people are not doing their job, any of them, and because I don't know what percentage of the transactions that we get involved with, if that's all we did, we'd end up with trouble on the buy side. There'd be a lot of transactions that could not be completed and a lot of failed exchanges. And by asking a few questions and knowing what questions to ask, you'll find out very quickly that even though the people might approach you initially and say, this is all I'm doing, and there's other things going on in their life, and there's other properties that might be selling, and it does come up all the time.
So if you're a broker out there, if you're going out on a listing appointment and you talk to the title company, get the trio, you get that basic title report that shows who owns a thing. If you're talking to somebody and they sort of are implying it's different than what that deed says, you got to start asking questions. And the transaction that I'm talking about right now, like I said, you have all these different parties involved, and you've got some kids involved too, and they've got these little tiny interests in these properties. So if you just, and a lot of people in our world might just say, or maybe tax and legal people not thinking about it, they say, well, okay, we're just going to do a drop and swap. Well, that doesn't take care of the situation, because if you just deed from that entity or group of entities down to fractional ownership interests in all these properties, now you got to sell all these properties to aggregate enough money to get somebody someplace. If it's the kids, they've got these minority interests, these tiny little pieces of this stuff. So instead of just doing a fractionalized deed out, maybe you're deeding entire assets out to to different parties of the transaction too. But this is where that planning component comes in. Have great tax people, have good lawyers involved, but really take the time to plan this out. And in that transaction, the reality is you're not just going to simply drop into a tenancy in common. You've got a pool of assets. You're going to, maybe somebody wants one of them to live in or something. I mean, all of those things are possible. So contributions, distributions in these entities is a big piece of it. And you think about some of our other, Jerry and Fred and all those guys the last couple of years, how many properties did they have that they jointly owned? And as they got older, they said, hey, for estate planning purposes, we want to break those things up. And you remember in that particular transaction, we just did swap agreements. And remember, I was funny because some of the legal people involved were like going, this is all there is? And we had the swap agreement that basically took care of everything in that situation.
Yeah, and a lot of times with these multiple owners, multiple properties, a lot of the assets are great assets and they want to keep them. They just don't want to own them jointly anymore. We've got a couple of properties. I want one of them. You want the other one, or maybe there's 3 or 4 properties. We each want to keep one of them and sell the others. Yeah, and it takes some planning, and so it's always great with situations like that where maybe they don't have to sell immediately and you can take care of some of these swaps a year ahead of time or 2 years ahead of time, and then they've got a situation where they do own the ones that they want to keep by themselves, and the other ones might still jointly be owned, and they can exchange out later on down the road.
So Tom just made a comment, and I want you to sort of elaborate on it. He said swap, okay? So in today's world, and you think about when we were first exposed to 1031 and our dad's comment, well, how am I going to find somebody that has what I want and I have what they want and it's mutually beneficial? So that first exchange or swap was truly that way. And then with accommodators, a third-party accommodation, what happened is you created a whole different world where if you look at our traditional business, we're just paid a fee to take a sale and purchase and turn it into an exchange, and the swap is between the taxpayer and us. But in what you just said, it's a totally different thing.
Yeah. They'll between owners, if let's say you and I both have a single family house that we own. Well, we own them jointly.
Several different ones.
Yeah, maybe it's and again comes down to vesting on these things. If we had an LLC that we're partners of, and that LLC's got 3 or 4 different duplexes, say, and we wanted to keep some of those. Maybe you wanted to keep one of them, I wanted to keep one of them. The third one was a dog we wanted to get rid of. In order for us to do any swapping, because what we really have is partnership shares, and the partnership owns the properties, we'd have to do a drop and swap, deed those properties, at least the ones we wanted to keep, out of the entity. Probably want to get all of them out of it anyway, but we deed them out to tenant-in-common ownership. And then as soon as we have that, and we're both on the title to properties as 50% owners, then I can swap 50% of my interest in the one I don't want for your 50% interest in the one that I do want, and vice versa. So we end up owning, maybe each one of us now owns the properties that we want to keep in whole, in full. And that third property is still under a tenant-in-common ownership with the 2 of us on title. And when we do sell it, then we can do our own exchanges out of that property. As long as it's in that LLC, then again we have partnership shares. We don't own real estate. The partnership owns the property, and the only way for there to have an exchange take place would be if the partnership did its own exchange.
So, and the other option, obviously, if we've got an entity that owns a bunch of stuff, instead of having the drops and the purchases and sales and the swaps later, you're just doing assignments of specific properties instead of an interest in a property or series of properties. So we're going to, in those transactions, we're potentially going to be using a swap agreement instead of a traditional 1031 third-party transaction accommodation agreement.
Yeah, because the exchange is not between Equity Advantage and the client; it's between two property owners. Which is kind of go back to the original
premise of the whole
1031 transactions back in 1921 when they started.
So even though this stuff's over 100 years old at this point, I just think that it's sort of the art of the exchange, right? I mean, we used to talk about that with Ron. It's the art of the exchange versus just being an accommodator and accommodating somebody's transaction. You really, that's what's fun, I think, for both of us at this point. If we were just doing exchanges of dirt or rental houses and stuff like that, we'd probably... boom, we'd be, it'd drive me crazy, right? But the fun stuff is when we get to sit down and go through these transactions with people, figure it out. I had a transaction on Monday, so my first day back, I got a call from a broker that had a transaction. We first started talking about just doing it simply as a reverse exchange, and the first thing Tom and I, we're it's not that we're interrogating our client, but we really want to understand what we're doing and how they own stuff and what their ultimate objective is. And so it was sort of interesting because on this call, I'm going through, I said, okay, so I'm going to ask you a series of questions. And one of the first ones was, well, on this, what do you have and what do you want, obviously, but then how do you own this thing? And it was sort of, and keep in mind that deed doesn't necessarily indicate ownership. Benefits and burdens of ownership do. And if I were to buy a property from Tom on a land sale contract, I wouldn't have title to it till I pay off. So, that's just a simple example of it. But we've got all the time we get involved with deals with transactions where that deed is entirely incorrect. And they're going to file a correction deed to fix that thing. So if you've got tax returns that show that we've both owned this thing over a number of years, but I've only been on title, so we've both had depreciation, we've both shown the income, both shown all those benefits and burdens, and treated as such for a decade, and the deed only says I'm on title, we're going to have that thing fixed and make sure that the purchase sale agreement reflects that thing also. But it was interesting because I kept asking the same question and sort of getting different answers. And so finally I got an answer that was accurate and got us where we needed to go. And I guess with the reverse, I think your position is probably, I don't want to put words in your mouth, is similar to mine, is that we're going to use the reverse as a fallback, not as a primary. But in this particular transaction, the numbers were not matching up. The replacement property that was targeted, that the offer was going to be made, was several $100,000 less than what was going away. And so I started, given the broker, kudos to go have to buy him something else. But by the end of the conversation, turned out there was going to be several $100,000 worth of improvements to be done on that property, the target property. So whether we do that purchase as a reverse exchange or an improvement exchange, really structure is very similar. It's just during the time we're on title, we're going to be doing the work on it. So it didn't really matter if they had the money to buy the property, get the project going. We're just looking at sliding timelines. If we buy it first, get started, that's going to start the 180. If it was going to be a sale, we got to go forward. So really what I told them is as far as your closing, ask for whatever time you feel you need, but really talk to in this area, talk to the planning departments, how long is it going to take you to get the permits to be able to get started on this stuff, and then sort of structure the transactions, those closings around those dates. And then if we're talking to you from Oregon, so there's certain times of the year where you probably don't want to be building too. So you got to keep that in mind also.
Yep. Yeah. To jump back real quickly on, we talked about identification, and just wanted to reminded me of a conversation I had with a gentleman yesterday he's in the middle of an improvement exchange, and his ID deadline is coming up in a couple days. And so we started talking about the identification, and he had turned in his identification and just wanted a phone call to go over it, make sure everything looked good. And I'll have to give kudos to our counselors in here because they gave him great advice. I gave him a call and pulled up his ID form, and he's got the property address listed nicely on the form, and he's got with improvements on there, and a little C Exhibit A. So he included all of the work that he expected to have done on this property with the final number there at the bottom of it. And why that's important is, in this case, I think his acquisition of property was about $400,000 or so. He had to get up somewhere around $600,000 for his exchange transaction. So not a huge improvement exchange, but still a fair amount of money. If he had only identified the property itself at a $400,000 property and did not list any sort of improvements, I'm not saying that he would have an issue with this, but if he got audited, the IRS could look at it and say, well, he not only got this property, but he also got improvements that were another 50% on top of the value of what was identified. And it could be looked at as he did not necessarily receive what he had identified. And the IRS does say that you have to receive substantially the same thing as what was identified in your ID form. And so, if he was doing a very minute amount of improvements and it really wasn't changing the property that much, probably fine in not identifying the improvements. But in this case, it was certainly great that he had done so, and not only done so, but he had listed, I think he had about 3 pages of everything that he expected to have done on that with values assigned to them. So it was a very, very good ID form.
Good job, team advantage. So I remember, to your point, to identify. So you've got to give what the government would deem an unambiguous description of what you're intending to buy, and you have to receive, quote unquote, substantially the same thing. And I remember a meeting, this was probably in the late 90s, at Ron Schellen's office. And it was actually with a couple of brokers that we still do business with all these years later. And the property, Ron was arguing that the client had to get 51% of the asset because he had he ID'd the whole thing, and he was going to buy a piece of it. And Ron was fighting to get the 51 versus a 50 just so he'd have at least a controlling interest in the thing, so it would be, in his words, that much better as far as the identification is. And I'm not saying 50% is enough or whatever it is, but that's one of those conversations you want to have, and that's why it's important. Like Tom said, you've got to give that unambiguous description and really work to take care of it. And that's why if you're buying a DST, you're identifying the portion that you're going to be buying, not the offering, because you're not going to do that. So
yeah, that question came up at the conference last weekend. One of the advisors said that he had an ID coming up, and was it important to identify the percentage ownership? And I said, well, yeah, unless they're going to be acquiring that entire DST themselves, which is not going to happen, then yeah, they should have the approximate percentage ownership that they're going to be acquiring. It doesn't have to be exact, but you do want to be fairly close. So you are, again, acquiring substantially what was identified, substantially the same property.
So I think we'll wrap it up in a couple of minutes, but I'm going to ask you just to sort of explain a little bit more, since we talked about improvement exchanges a little bit, or reverses. Just maybe the details, because a lot of times people ask, well, gee, I want to do this and that improvements to it. I'm just going to have escrow have a holdback, or I'm just going to have the money, I'll pay for it out of closing. What actually has to happen in an improvement exchange for those improvements to qualify towards the transaction? Does the project have to be done too, or what?
Yeah, so first of all, only the improvements that have been completed to the property at the time that the client receives the property will qualify for the exchange.
So what happens if I get to the 180th day and I've got $100K sitting there and I want to go prepay labor and materials?
Doesn't work. Can't prepay for anything, and materials and labor cannot be prepaid. If we're at day 179 and you've not spent that money, and we're entitled to it, because we have to form these LLCs. It's a single member LLC, limited liability company, that's referred to as an exchange accommodation title holder. That's what it's referred to as in the industry, or an EAT. And so if our EAT is on title to that property at day 179, you've got $100,000 left in the cash, or the cash left in the account. We've got to transfer the ownership to you. So we do so either through a deed transfer, or what's preferred is if we've got a single exchanger or a couple that's in a community property state, depending on the ownership, we would just assign the membership interest in the EAT over from our corporation over to the taxpayer, over to the exchanger doing the deal. But that cash, that would be taxed. It's going to be cash that they receive.
So in the improvement exchanges, basically, we can't give you the property and do the improvements. The improvements all have to be done prior to transferring it to you. So, like Tom said, I really like the assignments, and just as we talked earlier about assigning a given property to those respective parties in that transaction I mentioned, we really like, because you think about if we buy the property in a reverse exchange or doing an improvement exchange, we're buying a thing, taking ownership for a period of time. You've got a title policy in place, and the title policy is going to be for that entity. And if we transfer from that entity, deed it from that entity over to the taxpayer, is the policy still in force? Where doing the assignment is always going to take care of that.
Yeah, and the other great thing about it is, oftentimes there's financing on it, and so if we put together our EAT is on the actual financing, the name is on the financing, the client is always going to be providing the personal guarantees and qualifying for the financing. But we've got agreements between ourselves, the lender, and the client that at the end of this transaction, the membership is going to be assigned over to the taxpayer, and the bank's not going to treat that as though it's been an ownership transfer and triggered due on sale clause. But to your point, the loan doesn't get affected. It doesn't have to be assigned or assumed by the taxpayer, because they're just taking over the LLC that's on the financing.
And if the project's not done, all those construction contracts, everything stays in force, no change. So once again, people ask all the time when I want to know about an exchange. Obviously, we want to know any time before any closing. Do not, if you had a sale fail on your relinquished property and somebody says, let's just buy the thing and we'll do a reverse exchange later. No, you're not going to. Make sure that the transaction is set up prior to closing anything. You can't close on the replacement and then call us to do the reverse later. We've got to be involved at that period of time. So I tell people, I say, look, I want to know, ideally, we know you're not going to own it forever. So think about the exchange when you buy stuff, that's going to impact the ownership structure. But at least think about, before you ever sell anything, talk to your tax people, understand what your tax obligation is going to be. As soon as you understand the tax obligation, then you can justify the transaction. And Tom and I have been doing this a long time. We don't have to do your deal to survive. We want to make sure the exchanges are warranted and we're getting you where you want to go. And like we were saying earlier, it's not all or nothing, but it's all about planning. Call up. The only dumb questions when you don't ask. Call up, plan it, figure it out, because we really want to understand where you are today and where you want to be, and whether it's investing, whether it's improvements, whatever it might be. This is something that you've been working for a long time to accumulate this money. We say you've worked hard for it. We want to work hard to keep it yours. Time is what allows us to do that.
Yeah, and if they do have, if they're in those conversations with their tax and legal people, I'll always throw it out there. I'm happy to jump on a conference call as well if they just want us to sit in and listen and see if we see any issues with anything that's popping up, because everybody's got their little specialized field, and we'll want to stay in our own lane, but we will oftentimes have pretty valuable information to add to a conversation.
So Thank you for joining us today, Dave and Tom Moore, the Exchange Brothers. And if you've got questions, please don't hesitate to reach out to C. Moore, C-M-O-O-R-E, at 1031exchange.com. We are always looking to provide you content that's valuable to you. And check out our YouTube channel and everything, because we've got a lot of information on there outside of 1031s, everything from charitable remainder trust, cost seg, selling life insurance contracts, all kinds of stuff. But like I said, if you got questions, don't hesitate to reach out. We are the guys with the answers.
Try to be.
Try to be. Thank you.
We're
very
still
much.
learning.
Yep. Hey, happy to learn, tired of being taught, right?
Yep.
Thank
Right.
you very much.
Thank you.